Inflation in the 20-nation Eurozone fell to 8.5% in January, exceeding analyst expectations ahead of a key central bank meeting. The new figure continues a three-month trend of slowing inflation, thanks in large parts to falling energy prices. And it's likely to put more pressure on European central bankers before their meeting this week. For a closer look at the matter, let's bring in Clemens Fuest, head of the IFO Institute, one of Germany's most renowned economic research institutions. Welcome back to the program, Clemens. So consensus among financial experts is that the ECB will raise interest rates by another half a percentage point tomorrow. Is that necessary in light of the data that we got today?
I think it is clearly necessary. What we see is that, yes, headline inflation is coming down because energy prices are easing a little bit, but we don't know how long this will last. And what's more worrying is that core inflation is on the rise and has been on the rise, and this is likely to continue. So against this backdrop, it is important that the ECB does signal it is determined in its fight against inflation.
Let's talk about this core inflation here in a minute. But before that, so you mentioned it yourself, energy prices have been dropping, have been decreasing dramatically when it comes to natural gas, for example. So how much of this easing in inflation can actually be attributed to the attempts of the European Central Bank to fight it?
The impact of monetary policy comes with a lag. So it's unlikely that current economic policy action has a big impact on inflation. It does influence the exchange rate. That's an immediate impact because with a tighter monetary policy, the inflation, the exchange rate of the euro is stabilized and rises a little bit. But the major impact comes later. And part of the major impact is, of course, that inflation expectations will change, and that will induce people to change their plans. So if people think inflation will be high in the future and the central bank will do nothing against it, they will adapt to that and increase wages more. And the objective of monetary policy is to prevent that and to convince people, yes, in 1 or 2 years, we will be back to lower rates.
And we have to keep in mind, of course, that 8.5% for January is more than 4 times higher the ECB's inflation target. Now, your institute is warning of high inflation solidifying. You mentioned core inflation is rising. Why is that?
This is because, given that we currently see a high inflation, a lot of agents in the economy, in particular in wage bargaining, adjust to that. And they think, okay, inflation will be higher for some time, and that's a self-fulfilling prophecy because then wages are rising more quickly. Companies raise their sales prices and inflation broadens out. So it extends beyond food and energy. And that's dangerous because once people really adjust to this and believe inflation will be higher, it becomes much more difficult for the central banks to fight this. So the central banks need to be determined and keep inflation expectations low.
How big of an issue is the disparity between Europe and the US when it comes to inflation and central banks' attempts to fight it? Briefly, if you could.
The difference is important. So in the US, inflation is less driven by energy prices and more by domestic factors because fiscal policy has been more expansionary. That's why we see this rate difference now. And the ECB should indeed focus on the European situation and less compare itself to the Fed.
Clemens Fuest, president of the IFO Institute. Thank you for your analysis.
Thank you.